how do I get the 20% deduction from Trump's tax plan? Well, first off, it's not Trump's tax plan.
I wasn't going to say that,
It's
but go
the
ahead.
Tax Cut and Jobs Act, and it was passed by our wonderful Congress. Because technically, though they seem to forget this, presidents don't write laws. Okay, now we get that out of the way. They did put this thing called a 199A deduction, which is a 20% deduction on qualified business income from pass-through entities. So follow me here. First thing we need to have, and I'm going to kind of write these up, is we need to have a pass-through entity. And you can be an LLC taxed as, this is a 1065, that's a partnership, a sole proprietor, a C Corp, no, excuse me, C Corp doesn't work,
No.
or as an S Corp. Those are your choices. Technically, it could also be a trust. Then you look at other entities, S Corps, and just flat out partnerships, including limited partnerships, all that fun stuff. So it's passing through. It doesn't pay its own tax. Then you need qualified business income. I'm just going to call it QBI, which is just means income. Generally speaking, it's active income, but they also include real estate. If you are making money on real estate in which you participate in some fashion. So the only type of real estate that's not included as far as we can tell, because they're still giving us regulations on it, but the proposed regulations make clear that real estate, rental real estate is included, is if you have a commercial building and it's triple net leases that you're giving out, where you're not really taking on much of the risk, then they don't let you have the qualified business income. Then they compare that qualified business income, 20% deduction, versus 20% of your taxable income, whichever is less. Why is this important? Because if I'm a sole proprietor, let's say I have $50,000 that I'm making net, I would get a $10,000 deduction under the QBI. But let's say that I take and I contribute into my retirement plan. Husband and wife, sole proprietors, still the same thing, and they both put in, what's a good number? Let's just say $10,000. Mm-hmm. Then my taxable income is actually $40,000 because I wrote off. I made tax deductible contributions into my IRA of $10,000. So I would take the lesser of that. Then they do this wonderful thing. Is they then say, well, if it's a special service company, we're going to put a cap on how much QBI you can actually make. And it's really not QBI, it's actually your taxable income. And they say, we'll only let you write off so long as your taxable income is below a threshold. If you're single, that threshold is $157,500, and there's a phase out over the next $50,000. So to make your head spin, it goes from 157 to 2075. That's the easiest way to look at it. If you're married filing jointly, those numbers are 315 to 415. So
what's an example of special service?
Yep, special services are something that it is you and your skill that makes the money. And they use, it's going to be doctors, lawyers, accountants, engineers, real estate agents who are solo, somebody who it's their skill, so like a carpenter who doesn't have a bunch of staff. That's going to be a special service. And if you get above those thresholds, you are done. Somebody's asking a question. This is pretty interesting. A single member LLC counts. So like you have a flow onto you. So that's when you're a sole proprietor or just going onto your tax return. That's a pass-through entity. So you're fine. The interesting thing here is that you can control your taxable income. So even on those thresholds, and when we teach this in the class, we actually go through kind of a learning chart where we say, if this, then this, if this, then this. So if you're special service, we just need to make sure that we can control your income. And the way you control your income is by splitting it with tax-free or tax-exempt or separately taxable entities. So let me give you an example. If I have a C Corp and it makes a bunch of money, great. That's not income to me. I don't want to pay myself a whole bunch of money and make whatever my other business is that is where I'm underneath the threshold taxable, because I'm losing that 20% deduction. So let's say I have $200,000 coming in as an individual. I can get some donations and deductions from into a retirement plan, and I get myself underneath that 157, and I have another 200,000 in a C Corp that I can pay myself. If I leave the 157 as is and I don't take any money out of the C Corp, I'm going to get a 30 some odd $1,000 deduction. It's just going to come off the top. It's a 20% deduction. It's almost like I spent it. If I took the money out of the C Corp, and by the way, that C Corp is at a flat 21% tax rate now.
Mm-hmm.
So it's going to pay 21%. So like it's not horrific. But if I paid myself that money, I push my taxable income over the threshold, and now I get zero deduction on my qualified business income. So that's why it's important. If it is not a special service, then those thresholds trigger something else. It takes us to an area where we can write off up to 50% of the W-2 income or 25% of the W-2 income for the business.
Oh, yeah, you're right.
Plus
right.
2.5% of the assets. Sorry, Joe, I just go off.
No, you're right. I'm just jumping ahead of you.
Yeah. So what we're looking at then is you better have a regular business that actually has salaries. If you, for example, as a sole proprietor, single, are making, what would be a good example? $200,000, and you're over the threshold, you're phasing out, you would end up with, you'd have to go to the second test. You're over the 157, and the second test is now pushing you to that 50% of W-2 wages, and you have zero. So your deduction is going to be zero. You're going to get literally nothing. You might get a few dollars because you're not quite at the 207, which is the top line of the actual phase out. So you'd be phased out about 90+% of the benefit. Now let's say you converted that sole proprietorship to an S Corp, and instead you paid yourself a salary. So same situation, 200,000, let's say it paid you $75,000 of salary. Then the QBI, the monies that's flowing through, is actually the net income, the net profit. So you'd subtract the 75 off, so it would be 125,000.
Right.
You'd compare 20% of that number, which I should have grabbed a calculator, whatever that number is.
25,000.
Yeah, 25,000. And we would compare it to 1/2 of the W-2 income, which would be 37,500. So you get the lesser of the two. You get a $25,000 deduction just because of the type of entity. So that's the one I have to do. Somebody just said, I have almost 300K in real estate and other income. Is there anything I can do? Single person? Yeah, there's something you can do. Because remember, it depends on whether you're special service, and then it depends on the business. And there's one last thing. It always comes down to your taxable income. What other ways can I use to control my taxable income? The most obvious is I split it with a C Corp. I give it to charity, and it could be my charity, or I I deduct it by putting it into a tax-deferred retirement plan. So, for example, same situation. I'll use the 200,000, and they do a 401k, and they put husband and wife each. They're under 50. They each contribute 18,500. Or actually, the example I used was a single person, so I guess I would have to say I put 18,500 in, and then they get a 25% deduction on the 75,000. So they would put in, again, I'm using crazy numbers. So what would that be? About $18,750 or whatever that is, around another 19,000. So I can put, in essence, about $37,000 right into the 401k, and that reduces my taxable income. My taxable income goes from 200 down to almost the threshold, and now I don't have to worry about it. Makes my life so much easier. I'm just going to get a nice big fat deduction, and I'm happy as a clam. That's how this stuff works. But if you don't do it before the year end, you're toast. And so this is going to be this is why you need to have some sort of somebody doing tax planning with you. So how do I get the 20% deduction from the new tax act? Very deliberately. You make sure that you have the income flowing onto your return, and then you make sure that if there's a disqualifying factor that would cause you to lose it, that you look and say, what's better? To just walk away from it and not worry about it, or would I be better to take a couple of actions to allow myself to take advantage of the deduction? It's a freebie, guys. It's if I make $20,000 in real estate, that rental real estate, that's my net after all my depreciation. I get a $4,000 deduction. I'm only recognizing $16,000 of it as taxable income. So that's a nice little benefit, especially if I'm a high income person. So that's what I'd be looking at.